always say, look at those year-end bank statements and credit cards, because you can kind of line up some of your deductions. Because as your income is super high, but maybe your bank account's really low, you're like, okay, what happened here? There's a disconnect. Or maybe there was a different thing that went on, like maybe some stock options exercise that all of a sudden went way up on your income. And so there's things like that we just need to kind of figure out.
We'll go ahead and get started. For those of you that don't know, my name is Jaimin Garabedian. I am the owner of Assurance Wealth Management and Assurance Family Office. We host these webinars once a month. Every month is usually a different topic. We usually bring on specialists that come in and talk on whatever the topic of the month is. And this month, like I said, we are fortunate to have Rachel Knapp, who is a CPA and partner at Ramdas Accounting. She is also, for those that don't know, a certified financial planner, non-practicing, but she's got all the education and the tools to help with all of that as well. So, Rachel, thank you again for coming in and doing this with us.
Of course. It's so much fun.
Yeah. And, I usually end up buying her a lunch after this to say thanks anyways. But today we're going to cover a lot of tax strategies and a lot of breakdown, and we're going to try to section this off from individuals and families that are pre-retirement. We're going to look at individuals and families that are retirees, and then we're also going to look at business owners and different strategies for them. And I want to say the last time that we did this, we kind of went in the order of individuals, then retirees, then business owners. And so we kind of squeezed business owners in towards the end and didn't have as much information on them. So I think today we might just flip-flop the order so that way we can get a little bit more for the business owners that tuned in, because I did have a bunch of questions after our last one from business owners that had some questions. And so we'll kind of transition through a lot of this, but keep in mind when we're talking business owners, we're not talking, necessarily, the owner of Apple or Tesla or, these major big companies. If you've got a side gig, an Etsy company or whatever it may be, as long as you're out there doing something and making money, you're technically a business for yourself, whether you've, formed an LLC or not, or done any of that. So if you are selling anything, making any money on the side, doing photography or selling little gadgets, it doesn't matter. That's a business. And so now we just need to figure out how to utilize that business to save you as much in taxes as possible. And that's where a lot of this is going to come in today. And you'll keep seeing me look to the right here, I guess my left, you're right. But I've got a large list of questions that we've had come in. And so typically the way that this works with Rachel is I'm just going to start firing them off at her and let her expertise help you guys out here. But one of the things that I kind of always am curious about and get asked a lot about this time of year, especially when people are trying to get their paperwork ready for taxes and they're getting ready to file for taxes. The two questions I think I get asked the most is, one, do you know a good CPA that we could go get help from? And I try to tell a lot of people, this is not the time to switch CPAs, is in February. They are very busy, so not usually the best time. But the question number two, and that I'll ask you, is what strategies or what can people do, and doesn't matter if they're business, retirees, or individuals, what can people do this late in the game before filing? The most common things that can help them lower their either taxable income or get more credits or increase deductions or whatever it may be. What can they do now that 2024 is over before they file?
So the biggest advice I can give people is to get organized. Tax documents are coming in daily through your mail or through your email or things like that. So I usually say, look at your last year's return. That's a good roadmap to what you're going to have for 24. There's not going to be too much of a change. You might have changed jobs or something like that. So there's a couple extra little forms. But then I always say, look at those year-end bank statements and credit cards, because you can kind of line up some of your deductions. Because as your income is super high, but maybe your bank account's really low, you're like, okay, what happened here? There's a disconnect. Or maybe there was a different thing that went on, like maybe some stock options exercise that all of a sudden went way up on your income. And so there's things like that that we just need to kind of figure out what's going on for an organization standpoint. So that's a big one. Those summaries for credit cards, those are awesome for catching deductions, especially for charitable, because you might get like a receipt here and there, but those Amex statements I know at the end of the year will say total charitable will be like $10,000. And you're like, oh, I only have receipts for $3,000. So if you're going off the receipts compared to what's on your credit card, you might losing some deductions there.
And that brings up a good point. If, whether it be business owners or individuals, if they don't have receipts, business owners do a lot of dining or taking clients out for food or whatever it may be, and they don't have receipts for that kind of stuff. Is it still something that they either write off or get deductions on or whatever it may be?
It still can be. I will say, though, if you are audited, the IRS wants a copy of that receipt. So you have to keep receipts if you're going to claim it on your taxes for that reason. But yeah, overall, you don't have to have it in order to claim it on your return. Like you're not submitting proof of receipt with your tax return.
Okay. Yeah, that makes sense. And so do you have any specific recommendations that you've seen work really well as far as keeping track of all those receipts? Any system or software? I know we're in the tech age. So is there anything that you use or that you see people use that works really well?
For my business owners, most of their bookkeeping software has an app that you take a picture and you tie it to that expense for when you're categorizing it. That way it's all uploaded there. A lot of my individuals like to use Intuit or Quicken. That way they can just keep track of every little transaction they have going on. And that has the capability also snapping a picture of the receipt and uploading it and keeping it. If you want to, you can do the old-fashioned way of sticking it in a folder in a file cabinet and leaving it there. I will say those carbon copy for meals, they start to disintegrate after a couple of years. But you only have to keep receipts for 7 years. So any tax things that you have back from the 80s, go ahead and shred them. You don't need them anymore. But the IRS really only goes back 3 years unless they really think you did something wrong, and then they'll go back 7 years. Now, they think you have fraud going on, they can go back as far as they want to. So Just keep that in mind. So the safe number is 7, but if you want to be a little more risky, you can go for 3 years.
Living on the edge there, almost 3 years worth of receipts piled in a cabinet somewhere.
3 years is about how fast the IRS works anyway. So, there's that.
Oh, and I will say this just came to mind. It probably should have said on the front end, but for the purposes of this webinar, we are not giving advice. This is all for educational purposes. We're answering questions for educational purposes. Whether I'm your financial advisor or she is your CPA or both, we are not during this video. Okay. So don't take anything we say here today and go off and run with it. Make sure to do your due diligence, to look up, the information that you need, to talk to a professional before you go off and implement anything. There you go for the compliance lawyers and SEC out there. You're welcome. So what, we talked a little bit about things that people can do now before they file their taxes. What do you see as large mistakes that people are typically making around this time that end up costing them taxes?
The rushing through, whether they do it on themselves or they're getting the paperwork to the accountant because they're running late and the accountant's yelling at them. Either way, just rushing, that always creates mistakes. So you need to, like I said, be organized up front because that's going to save you lots of money. But rushing through a return is going to definitely cost you because either it's very easy to transpose a number. So you flip 2 different numbers and all of a sudden you have an IRS notice. So things like that. On
the wrong point causes some big issues.
Yes, exactly. Yes. A lot of times too is you kind of want to, if you do your return on your own, you want to look at things as reasonable. So if you're all of a sudden expecting $20,000 back on a refund when usually it's like $5,000, you probably did something wrong in that preparation. And vice versa. If all of a sudden you're owing $20,000 when you're normally break even, you probably did something wrong in the input. So it is nice when it is a third party doing it because you have a different set of eyes on it. Mm-hmm. And also, from a behavioral science standpoint, a third party is more likely to catch mistakes than your own eyes. So it's been kind of fascinating watching that kind of science that you're less likely to catch your own mistakes compared to somebody else. So kind of interesting. Yeah.
And when you're talking about rushing it, I mean, obviously everybody's taxes are, due on April 15th, the due date, but they're not really, right? I mean, and that's the thing is everybody, I think, rushes to get everything done between January and April 15th, where, they're waiting for a 1099 that they may not get till late March, or they're waiting for, Schedule K or whatever they may be. They're waiting on all these forms to come in, and then they were like, "Oh, I've only got 2 weeks to get this done," and so they do start rushing.
Yes. So there's no problem with extending. I will say extending means you have more time to file. It does not mean you have more time to pay your tax. So keep in mind that your tax is due April 15th, no matter what. So that is if you owe. Just kind of say that. Anything that is due after April 15th that you didn't pay will incur interest and penalty. And right now that interest and penalty rate are pretty high because they're with the standard market rate. So I do always tell people, even if you're going to extend, run an estimate, kind of project out, just kind of drop in some numbers of what you think maybe that Schedule K1 is going to say, to get an idea of what your tax return is going to look like. That way, if you do need to make a payment, go ahead and make that payment. That way you're not incurring more interest and penalty.
So it may not be a bad idea to not necessarily rush, but to hurry to get your numbers put together so that you can make some sort of payment that's reasonable for what you're expecting to be paying, if you're paying anything. But don't necessarily file. You can still get your extension, just pay what you think is reasonable, and then kind of take your time and mark things up the right way.
Yep, exactly.
Perfect. Well, when it comes to filing, when it comes to, you mentioned the IRS coming back and looking at you, do you see any really common red flags that are like, the IRS sees something in particular and they're like, oh, that's an audit every time. There's because I think between social media and all the, the TikTokers out there giving us all this great tax advice, it's causing, from what I've seen, a lot more people to do some things that they heard on social media that may or may not be the most legal thing to do. So other than taking TikTok advice, like what do you see as being big red flags?
The biggest red flag is always being way above the average. And I say that from a deduction kind of standpoint or from a loss standpoint. So for those who itemize, if you are way above the average of a standard Schedule A, which married filing couples, you have about $30,000 as a standard deduction. The average itemized deduction for married filing jointly is about 35 to 40. So if you're itemizing and you're closer to like 80,000, you have a higher chance of being audited. Now, I will say, if you do get audited, it's not that big of a deal as long as you have all the documentation at hand to just hand over to the IRS to be like, here's proof to justify all my deductions. Mm-hmm. And most of the time, if you have it ready to go and you respond timely, they'll send it back and go, okay, you're all good. Now, with the losses, so those who are taking like the Schedule C, your business that are taxed as sole proprietorships, if you're having, $30,000-$40,000 losses, and most of that is coming from meals or travel, I can guarantee you're going to get audited. And I can also guarantee they're probably going to throw most of it out because they're not going to be able to justify that much of a loss for travel. Usually those folks are the ones that are, buying limos and they're going to $900 meals for 2 people on a regular basis. And that's not ordinary or reasonable in the IRS's standpoint. So you see it a lot with like pharmaceutical sales folks whose, game is to just get their clients to like them and to entertain them and things like that. we talk about the Enron failure and Arthur Andersen, and you get into where the auditors were doing, and, Enron was taking them out to extraordinary dinners and taking them to, suites at ball games and things like that. So those are very hot topic items.
Gotcha. And when you say, that reasonable, these reasonable losses or deductions, let's say that you've got a startup, or we've got somebody on here that has like a little side hustle that they like and they want to start up a business. What is a reasonable amount that somebody says, I wanted to start this business, I wanted to get into this and start making money, but I'm just not? Like, what's a reasonable amount of time that you can show the IRS without any income or without any, revenue, or without any, net revenue? I mean, how long can you actually take losses before they're kind of freaking out on you?
You can take small losses, and that's usually up to about $7,000 for 3 years in a row. After that, if you're not pulling in income, or you're not seeing a trend in that loss decreasing, they're going to probably switch you over to a hobby, which then you're not going to be able to use any loss. So do try to keep it a minimum of 3 years. Now, I will say during the COVID years, no one got audited on that because everyone was running a loss. There was it was just such a weird time for everybody.
For a lot of reasons.
But for those companies that were like just starting to start up, and all of a sudden COVID shut down the world, of course they ran losses for several more years because it took a longer time to get back up and running.
Sure. Okay. So just kind of a general rule is 2 to 3 years of $7,000 in losses, and then you better, at that point, you better start making money anyways, or you're not really, you're kind of wasting your time on your business.
Pretty much, yes.
And kind of going back to the whole TikTok advice, social media advice, one of the questions that I had come in was, somebody said that they, business owners saw something about a section 179, and they had some questions about that. They also saw something called bonus depreciation on bigger purchases. So can you tell us what the differences are between those, and maybe when to use one and when we use the other?
Sure. So bonus depreciation is kind of a year-by-year thing. Certain years we were at 100% bonus depreciation, meaning the qualifying assets, because not all of them are the same, were eligible for 100% write-off right away, whether or not you had profit or not. So a lot of companies that were like building out a new office space, and they took over that office space at the end of the year. Okay, they spent $200,000 renovating that space. That was eligible for a $200,000 write-off. Now, right now, for 24 and 25, they've been phasing out bonus depreciation, so it's at 40% right now. Okay. So that means 40% in the first year can be written off. After that, over the useful life of your period, the remaining 60% gets to be written off a chunk at a time. 179 is similar to bonus depreciation. 179 allows you on certain assets, again, very particular assets, it's usually going to be like equipment. You can take 100% of that equipment and write it off as an expense. You do have to have enough profit, though, in order to utilize it. So if you were, say, before, you had bought a large, I'll use a physician as a per se. You bought an X-ray machine, and it was, $200,000. And at the end of the day, before depreciation is taken into effect on your clinic, you were running $300,000 profit. So that $200,000 X-ray machine would eat up $200,000 of your profit. All of a sudden, you're paying tax on $100,000 instead. Mm-hmm. So that's the difference. Now, however, you reverse it, the clinic at the end of the day has $100,000 of profit, and that machine was $200,000. You can only use $100,000 of the $200,000. The remaining $100,000 is going to carry over. So it gets a little more complicated.
Just use it the next year.
Right. It does carry over. Now, to make even more complicated, there's things of depreciation recapture. And this is where things kind of can come back to bite people in the butt when they accelerate depreciation, whether it be 179 or bonus. So if you dispose of that, let's say we dispose of that X-ray machine in year 2, we don't like it, whatever. So that means that depreciation that you took for its whole useful life, okay, now majority of that's going to come back and you're going to be taxed as ordinary income on the excess that you took. So if that useful life for the X-ray machine was 7 years, instead of writing off 1/7 each year and you took 100%, 6 out of 7 of that $200,000 is going to be taxed at ordinary income to recapture the excess deduction that you got. So it can become a very complicated subject.
A lot of fun
and there's
math
all
there.
sorts. Yes, there's lots of consequences with it. It can be a beautiful, beautiful deduction, but we also need to walk through what's the long-term goal with it. What are we thinking? What are we looking at, income-wise for the later years to see if it even makes sense to do it? Because sometimes folks are like, you know what, let's stick with regular depreciation and just do 1/7 at a time because it'll work better with my cash flow purpose for tax payments. And that's okay. And so it's just something that we need to run different avenues with and show you the different projections so that an educated decision can be made on it. Lots of people just jump into it going, oh, I get to write it all off. And then the next year they buy another equipment thinking they get to write it all off while they traded in the old one. And I'm like, guess what? You don't.
It doesn't work like that.
Yes.
Yeah. Oh, that's a lot. That's probably something that those online tax filers don't sit down and explain with you.
Yes. I could spend a whole hour just getting into the differences there and the consequences of it.
Gotcha. Well, and kind of switching from office mentality to still business owners, but now at home, a big deduction for a lot of people tends to be their home office. And
Mm-hmm.
I mean, you can speak to that. You're sitting in one right now.
Yes.
So, what's the best way to legally, obviously, maximize the deductions that you can take for a home office?
So a lot of it kind of depends too on how you're taxed and things like that. So if you're taxed as a sole proprietorship, goes right onto your Schedule C. You won't be able to use a home office deduction unless you have profit. And that home office deduction is limited to that profit. So kind of keep that in mind. If, though, it comes from a K-1 of like a partnership, so you're still incurring self-employment tax, you can use a home office deduction even if it was a loss and still use the deduction there. Now, if you're an S corporation, you have to get a little more creative with it, but it's still allowed because it's still an office space. But instead of it being claimed as a home office deduction, it's going to be claimed as an office space or office rent onto the S corp return. But basically what we're going to look at is we're going to look at the total square footage of your home, the total square footage of the office space, and then you're going to take a pro rata version of, mortgage interest, property taxes, home insurance, yard guys, housekeepers, pool maintenance, every little thing that kind of goes into running your house, pest control. What else am I missing? Just maintenance.
Yeah.
Good God, houses are expensive. But yeah, so it can add up real quick. The thing a lot of people will tend to go to is, I can depreciate my home and a portion of that.
Mm-hmm.
Keep in mind, though, that when you go to sell your home, that kind of comes back to play. So there is a long-term consequence of that. So I try to persuade people not to depreciate their home for that reason. Plus, they're going to disclose it to the IRS, and then all of a sudden the counties want to tax you as an office building, and then you can get into problems with the county not wanting you to have an office space in a residential area. So there's all sorts of issues with that. So it's better not to depreciate it.
So sticking to the proportion of your office to your home for all of the maintenance activities and property taxes and all that is probably the better way to go than to worry about the depreciation side of things.
Exactly. Especially you think now with property taxes on a Schedule A are capped at $10,000. So, here in Texas, our property taxes are always way over $10,000. So if you're able to use some of that, like $4,000 of it over to your business, that's great if you have like a $15,000 property tax bill, because now you're not losing as much to that $10,000 cap.
That makes sense. And I didn't know about that one, so thank you. And so kind of, staying along the lines, we got business owners in their home. One of the big things that you and I talk with business owners about all the time, and it can be used for a myriad of different reasons, whether it's, childcare or child activities, or just reducing your business taxes, or setting your children up for retirement with Roth IRAs and all that, is hiring your family members. And that's something that tends to be a big topic, again, on social media, is what is the best way to hire your kids, and how much can you pay them? And then, what kind of recommendations do you have around that whole incorporating your family into your business?
Oh, that's a fun one. Okay.
I know we talk about it all the time, but
we do. So the first off, the kids have to actually do something for the business. They can't just be your kid and you just pay them. But I do have where, I have a client whose daughters go in and clean baseboards at the office every 2 weeks, and that's what she pays them for. You also have to physically pay them money, which gets a little trickier if the child is under 13, because kids can't have a checking account under 13. So usually it goes from, the business account to mom and dad's account to the kid's savings account. That's usually kind of how that one works too. But that's a big one, because a lot of times people won't actually pay their kids, but they just put the paperwork in to make it look like they paid their kids. But you do physically have to pay them. I'm just going to reiterate that multiple times. Other than that, depending on how your business is structured, again, going back to a sole proprietorship or a partnership or an S corporation or even a C corporation. So any of the corporations, you do have to do payroll taxes on the kids. So that's the Social Security, Medicare, Texas unemployment, federal unemployment taxes. Now, if it's a sole proprietorship or a partnership where mom and dad are just one or the other as the sole owner, then they do not have to do payroll taxes on kids under 18, not even for state unemployment or for federal unemployment. So that saves quite a bit of money doing it that way. So a lot of times when we get into that, we sometimes set up like a family management company for the purpose of the business pays the management company, which is taxed as a sole proprietorship. And then the kids are paid from that family management company to get rid of the payroll taxes.
Sure.
Because I think that's 15.3% at a minimum on whatever you're paying the kids. And on top of that, I usually suggest not going over the standard deduction for the year. And the reason is the kids won't have to file a tax return because they're under the taxable income limit. And B, they're not going to have any federal income tax withholding, so there's no refund to claim back or anything like that. So it just kind of saves on the paperwork and the complexity of the situation to just keep it no higher than the standard deduction.
And one of the strategies that we talk a lot about with our mutual clients are doing those strategies, putting in place those strategies to pay your kids out of your business. And it doesn't have, keep in mind, people, when we're talking about businesses, you may have a W-2 employment job, and then you just do photography on the side or painting on the side, or you sell some widgets on the side. That's the business we're talking about. That's the business that you are now paying your kids out of there. And what we always typically recommend is for people, depending on their goals, of course, but if you're paying your kids the standard deduction amount, which is what for 2025, I haven't even looked yet.
$15,000.
$15,000. So you're paying them $15,000. You can go siphon off $7,000 of that, put it into a Roth IRA. Now these kids have an account that's growing for the rest of their life, tax-free, that you never paid tax on to begin with. So they have untaxed money going into an account that's now going to grow tax-free for the rest of their life, and set your kids up for retirement. Keep in mind, you can also use Roth IRAs for education purposes down the road, if need be, but that's a whole nother situation. But you put $7,000 into a Roth IRA, let that grow tax-free, and the other $8,000 you can now turn around and pay for their swim lessons or guitar lessons or whatever it is that your kids are into. So now the money that you were already going to pay for them to go do all their after-school activities just comes out of their account. I mean, you paid them, and it comes out of their account, but now it comes out of their account without ever having to pay taxes on that money. So it's a great tax saving strategy and allows you to do a lot of things with your kids that you're going to do anyway, except now we're just reducing your taxable amount before you do it.
Right. I mean, the biggest issue I usually see with the paying the kid method is those fake TikTok videos of, oh, your kids are now on the board of directors for your LLC. That, ski vacation you went on is now a business write-off because your whole board of directors was there together. No, doesn't work that way.
It would work that way, I'd assume, if it's like your spouse is on your board of directors and maybe your I don't know, your brother and your sister are on your board of directors. But for kids that are under the age of 13 being on the board of directors, I think that's going to draw a little bit of a red flag.
Definitely.
And the other thing is when you try to do stuff like that, you need to actually hold business activities on that ski trip there's a certain number of hours per day that you need to actually sit down and do business activities for it to count. So keep that in mind. All right. So let's our business owners that we've now talked about and had a little bit of strategies around that area, they've now retired. So we're going to look at some retiree stuff here. RMDs, and this is a question that I had come in from somebody, is what is the biggest mistakes that retirees make when looking at RMDs? I mean, I think I can answer this one for you. It's not taking them in time. There's a big penalty if you don't take your RMDs, your required minimum distributions, in time. If you don't know when you're supposed to take them, it's all based off your date of birth. So you can just Google required minimum distribution for date of birth and put your date of birth in there, and it'll tell you how old you are when you have to start taking these distributions. It used to be an easier answer, but then the laws have changed over the last 5 years, 5 times. So, and I think they're talking about changing it again. So we'll see. We'll keep an eye out for that. But at the end of the day, with your RMDs, if you have any sort of IRAs, 401ks, tax deferred accounts, those require you to take certain distributions, meaning the IRS wants you to pull a certain amount of money out of there per year so that they can collect the taxes on it. So there's a formula to figure it out. It should be on the bottom of your statement. If you have statements and you're over the age that you should be taking RMDs, it'll be on your statement. Just make sure you do that in time. And if you're unsure how to do it, talk to somebody. Get a professional to help you with it, because the penalties are not just the fact that, let's say you have $10,000 in RMDs and you take them late, you still have to take the $10,000 in RMDs. That $10,000 is taxed as income. So you're at the 20% bracket. Now you're pulling out $2,000 to pay the IRS, but then they also charge you a 50% penalty. So you are now also pulling out an additional $5,000, and all of that goes to them. So you get $8,000, the IRS gets $7,000. Not cool. Let's not let that happen.
Now, I will say, if you do miss your RMD, there is a form to request a waiver of the penalty. And I will say the IRS is usually pretty lenient on it. I have a lot of folks that, dementia kicked in and it wasn't discovered until a few years later, and then it wasn't discovered they didn't take their RMDs. So we just put it on the form of, hey, we have a dementia patient going on, and they had no idea where they were to begin with, but whether or not they had an RMD to go with. And a lot of times the IRS will grant them because they know, I hate to say it, they know the age of who they're dealing with. That's usually subject to RMDs. Yeah. Now, your inherited IRAs for the younger folks, they're not as lenient on, but you can still kind of request it, and most of the time they will grant it.
Yeah, so as long as you catch it before they do, you've got a chance of not having to pay those penalties. But as soon as you figure it out that you were supposed to be paying RMDs, get with somebody to help you fill out the forms and file everything the right way so that you don't have to pay those penalties. Let's see here. Is there a way that retirees can delay or reduce tax impact on RMDs?
Ooh, a good one is qualified charitable distributions, to where it goes straight from the IRA to a 501c3 organization. So it still shows up on your Form 299R at the end of the year, but you just let your tax advisor know that you made a qualified charitable distribution, and they remove the taxable portion amount out of your tax return. But that severely helps lower your taxable income if you just have it go straight to the charity.
Yep, that is about the only one that we ever look at using. Because the whole purpose of the RMD is that the IRS wants their taxes, so there's not a whole lot of loopholes around that one. When does it make sense to do a Roth conversion, and how can retirees minimize the tax impact? All right, I'll speak on this first, and then I'll hand it over to you. So I want to clarify two different things. A Roth conversion versus a Roth contribution are two vastly different things. I have a number of people that I've worked with in the past that told them, hey, we need to do some Roth conversions. And they always argue with me that they can't do it because they make too much money. You can always do a Roth conversion. There is no income limit on a Roth conversion. On a contribution, there is an income limit. And you'll just have to look up what that is. If you're single or married, they're two different numbers. But when we're looking at conversions, when's the best time to do it? Now. In most people's situations, if you're going to be doing Roth conversions, if Roth conversions make sense for you at all, it's typically better to do in lower taxed years, which we all know that as of right now, 2025 may be our last very low tax year for a while, unless Trump does something with the tax laws for 2026. Because in 2026, they are reverting and going back up. So with that said, now, today, this year is a good year if you're going to do them at all. To decide how much you're going to do, that's where working with professionals like a financial advisor and a CPA, not one or the other, but both, and have them figure out the right number for you, because it does have impact on both your investment financial plan as well as your taxes, and not just your taxes this year, but your taxes for the rest of your life, because there's a lot of calculations that go into this. And I think Rachel and I sit there and go back and forth a lot of times where, I'm trying to do the Roth conversion for investment purposes and she's trying to do it for tax purposes. And we've got to find a middle ground that works for their whole financial plan and that somebody's comfortable with. So there is no best time, or should I do Roth conversions or should I not? There's no blanket answer, I don't think, out there. It's a person by person, situation by situation difference for everybody.
Exactly.
How to minimize your tax impact, I'll leave that one to you. So if somebody is going to do Roth conversions, is there a way that they can minimize the tax impact of those conversions?
Usually we look at, like you said, the years of when income's a little bit lower. So it's typically the years where, you've retired, any deferred compensation's not incurring, up until the years that you have to start taking RMD. And we try to kind of play around with the brackets that we're looking at there and seeing how much we can fill to where they're comfortable with and how much of a dent it can do. Because if you have a very large 401k or a very large IRA, and we're only converting over like maybe $10,000, we're not doing a whole lot to your IRA, and we're not doing very much with the Roth conversion there is either. And so sometimes it does make sense to basically super fund it and just take a tax hit that year, especially when we look at from an estate planning perspective and we see, beneficiaries are all in the top bracket now, and they're just going to continue to be so. So it might make sense just go ahead and empty out that entire account that 1 year. That way we can go ahead and move all that growth for the rest of that person's life into a tax-free account. That way, from an estate perspective, their beneficiaries inherit it tax-free, and that saves quite a bit. We also work around those IRMA thresholds. Those are really fun because, right now we get them for 2025, but they're 2 years looks back. So what your 2025 income might be is dependent on what your 2027 IRMA is going to be. So that kind of makes it a little fun because they don't really tell us too far in advance what they're going to be. So it's kind of a little bit of a shot in the dark, but we're trying as close as we can to get to those brackets. Because most not to knock on your profession, Jaimin, but most advisors will say, we'll just fill up the 24% bracket and that's it. Okay, within that 24% bracket, there's three different IRMA thresholds, and it escalates real quick. And all of a sudden, folks are 2 years later having to shell out $500 a month for Medicare premiums because of those Roth conversions. So it is very much of a work, scenario by scenario. We're going to run so many different figures. From a tax perspective, we're going to look at it from an investment perspective to see what the growth might do. We might look at what is the expected R&D if we take out this amount of money. We look at what the beneficiary's expected tax rate is going to be, and we look at those IRMA thresholds. And then we have a whole conversation after all these different modules are put together to say, what are you comfortable with doing?
Yeah, I mean, and at the end of the day, I think both Rachel's job and my job is to come up with the most efficient way of you handling your finances, but it's not always about the numbers. So I think both of us always tend to look at it with our clients of, look, we're going to show you the most efficient and effective way of doing this, but if you're not comfortable with it, tell us that, and we can come up with an alternate, plan B or plan C or plan D. We can figure out one that you are comfortable with. But our goal is always to get you the most efficient, effective way of doing it first. So I think with anybody that you work with, it should be that way. But so to answer the question is, there's a lot that goes on with Roth conversions. And that is something that I never would recommend somebody taking upon themselves to try to figure all that out unless they just don't care about the impact of what those conversions are going to do. You talked about QCDs a little bit, those qualified charitable distributions. What should retirees consider when deciding where they're going to draw their money from? Meaning taxable accounts, tax-deferred accounts, or tax-free accounts, and in what order?
Oh, gosh. A lot of that has to do, I think, from an estate planning perspective, at least from my point of view. Jaimin, you might have a different take on that from an investment strategy point of view of which one probably preserves the most growth. But I look at it from, what do you want to leave anything for your kids? If you do you want them to pay the tax on it? And a lot of times most folks are like, okay, I don't want my kids to pay the tax on my assets after I pass away. So then we tend to draw on the taxable assets a little bit quicker. But from an investment standpoint, it might be a different order of operation.
It's a little bit of a different answer, but that's why we both do what we do. And if you have a CPA or a financial advisor that doesn't work with your counterparty, they need to, because there's a lot of what goes on in our industry and what we're trying to do with our clients affects what Rachel's doing with her clients. So it's a communication, having to talk and make sure we're doing the right things. But to answer this question, the financial advisor textbook tells you taxable, tax deferred, then tax free. You allow your tax deferred money to grow longer than your taxable. You allow your tax free money to grow the longest. There's your textbook answer. Does it work like that for everybody? Not even close. I would say most people, it doesn't work like that, because it's going to largely depend on the amount of assets you have in each bucket. It's going to depend on what goals you have, not just from an estate planning perspective, but what's more important to you, having more money at the end of your life or paying less taxes throughout your life. So those can all affect where we're taking money from and when. And it also has to do with, tie in, when are you going to take Social Security? You've got many years there that you can decide to take Social Security. And so what's important to you? If lowering taxes in general is the most important thing to you, well, then you need to figure out when you're going to take Social Security versus tax deferred versus tax free versus taxable, because when you're pulling from tax deferred and Social Security, you're now taxing your Social Security at the highest bracket. But if you are only drawing from Social Security and then maybe taking all your money for that year out of the taxable accounts, you may not know any taxes on your Social Security. So a lot of that has to do with coordination and figuring out, A, how much you have in each account, what you have available to you. B, what are your goals for retirement? Meaning, how much money do you want to leave to beneficiaries? What's the most important thing to you? Is it income or is it lowering taxes? mean, there's so many different questions to be asked there that I don't think any two people have the same answer. So I would definitely say if you're trying to get an answer out of this webinar that you can go run with, you're not going to get it. You're going to need to sit down and do a full financial plan or a retirement plan to figure that one out.
I mean, I always, whenever clients come to me with those questions, I always just run scenarios for them, and I'm like, here's if we take money from different buckets, and here's the tax effect of it. But I always tell folks, if you're looking from an investment point of view, you have to go talk to a financial advisor. I can only point you towards the tax perspective of it, but there's a whole other realm out there that needs to be involved.
And they need to be balanced. I mean, you can't, I don't think anybody should ever do anything fully for the purpose of financial planning, or like from an investment perspective. Just like I don't think they should do it just from a tax perspective, because one of them could hurt the other one. So balancing them out is kind of the most important thing there. The next question was about Social Security. Kind of answered that a little bit. All right, so this is for kind of everybody. If you don't itemize your return, what's the best way for taxpayers to get the most amount of deductions?
So you're going to be if you don't itemize, not a whole lot of deductions for you. Really, you kind of limit it yourself to either IRA contributions, HSA contributions, or if you're an educator, bless your heart, that whopping $300 that you get for spending $3,000. Those are going to be your biggest deductions that are going to be available to you. There might be some more credits, but from a deduction standpoint, which is different. So quick little rundown, deductions lower your taxable income, and your tax is based off of what your taxable income is. Credits will lower your tax dollar for dollar. So just kind of know those differences, because a lot of folks will go in thinking they're getting all these credits, but really it's deductions, and they don't quite understand why it's not having the same impact.
What are the most tax efficient ways to reduce capital gains when selling investments or real estate?
Oh, fun. Well, the biggest one's going to be the tax loss harvesting that, Jaimin's very good at doing. But another one is just going to be kind of looking at where your tax is falling. Where's your taxable income? Because that capital gains, if it's long-term capital gain, can be a very favorable rate. At its highest, it's 20%. At its lowest, it's 0%. So for a couple filing jointly, they have up to about $93,000 of capital gain if they have no other income that could be taxed at $0. So that's quite a bit of money that does that. That also includes for qualified dividends, not ordinary though. So just kind of know there's a little difference there. Now, if it's short-term capital gain, you're kind of out of luck. That's taxed at your ordinary rate, which is, again, tied to that taxable income amount. But long-term capital gain rates are very favorable. Do watch out. Once you hit about $250,000, you get subject to an extra 3.8% called the net investment income tax. And that's if your total income is over 250, not just your investment income. So that one kind of hurts people a little bit because that comes back in very aggressively. But the tax loss harvesting is a big one. So for right now, the losses haven't been that large from the market because the market has done well. The COVID years, again, very weird time for everybody, but the market responded extremely weird to it as well. So a lot of people made a lot of money, a lot of gains from those years. So they don't have as many capital losses that are carrying over. Because keep in mind, losses. Okay, yeah. Losses.
I'm sorry, those crack me up every time we talk about them. I'm like, hey, if you make money, we're going to tax you on the full amount that you make. But if you lose money, you only get to reduce it by this much.
Yes. But if you have, say you sell some stock and you're making $100,000 off of that stock. Go you. But then later down the line, the market tanks and you sell some other stock and you lose $60,000. That 60 and that 100 will net together. So now you only have a 40,000 capital gain. Now with vice versa, that you lost $100,000, but you gained 60, you have a net loss of 40. The IRS will let you claim 3. So the remaining 37,000 will go to the following
For the
year.
next 12 years.
Yes, but you only get $3,000 a year overall in losses.
Yes.
So it's much better to have the gains than the losses.
Now, here's a question I've been asked before, and let's say that same scenario. So you've got your net of 40,000 in losses. So this year I'm going to claim, negative 3,000. So I've got 37 left over to carry forward. The next year I make $30,000. Do I now get to deduct 37 from that carryover, or still just the 3?
You get to, if you have 30,000 in gain and 37 in loss carryover, you now have 7,000 in loss, but you get to have only claim 3. So 4 will carry over to the following year.
But 30 of that 37 you do get to deduct from your carryover, your 37 that carried over.
Right. So you won't pay any tax on that gain because it was eaten up by prior year's losses.
Perfect.
Now, I will say capital losses only carry over for 20 years. So if you don't use them by 20 years, they go away. So just kind of keep that in mind. So some folks, I haven't ever ran into no one got to use up their capital losses. I mean, it also, if you do pass away, that's the end of it as well. That I've seen plenty of, but I haven't seen it to where at the end of the 20 years, you have more loss to claim. So.
All right. This one's all for you here. What medical expenses qualify for tax deductions, and how can an HSA help individuals or families?
Oh, fun. Okay. Okay, I'm going to start with the medical deductions that count for your tax return. And I'm going to preface this with most 9 out of 10 people will not be able to itemize their medical deductions. Just with the way that insurance works and out-of-pocket limits and the AGI threshold that you have to hit in order to itemize, most people never get that far. Most people that are able to itemize, it is things like the things that put them over that threshold, or memory care or rehab or home health care for a dependent that either, has some severe disability or they're just aging and things like that. But your qualified medical expenses outside of that are doctors, dentists, prescriptions, hospital, parking. I don't know if anyone goes down to the medical center, but that costs an arm and a leg for your 10-minute medical visit. Labs, imaging, prescriptions. Those are all your qualified medical expenses that you can deduct on your tax return. If you have an HSA, you can spend money for all of those qualified as well. Now, if you have an FSA, which is slightly different than an HSA, you can also throw in over-the-counter medications that are FSA approved. Allegra, this is allergy season, so Benadryl, all the allergy pills, they're all going to be marked FSA approved, but you can use your FSA card or HSA card to go ahead and buy those. But you can't use over-the-counter on your tax return. So kind of keep that. That's a little different. I know, to make it super confusing for everybody.
All right. I've got one more question. I just realized we've got 4 minutes left.
Okay.
So for anybody that needs to go, we get it, no problem. But we do have one more question that I'm going to go through that was sent to us pre the webinar. And then it looks like we've had a few come in as well during the webinar. So we'll get to those. The last one I have pre-webinar was, how can individuals ensure they're taking full advantage of tax credits like the child tax credit or earned income tax credit? So how can somebody find where all these tax credits are at that they should be taking advantage of?
So I will say the IRS actually has a really good website and really good resources for this. And do you qualify? There's even like little questions you can walk through. I will say the child tax credit is for kids that are, they're under 17. So if they hit 17 during the calendar year, they're gone. They're no longer child, even though you're still supporting them for like another decade. But that one hurts. There's also income limitations for the child tax credit. So if a married filing jointly couple hits $400,000 and it's modified adjusted gross income, not taxable, which is different than your taxable income, that you lose the credits is there as well. So those are two big ones there. There's also then the child care tax credit for kids under 13. That's a little different. It's, it costs a mortgage to send your kid to daycare, but they will give you $600 for it. So the earned income, the earned income's a little bit more difficult because you have to be closer to poverty level and you have to have so many qualifying dependents. I don't find too many people meeting earned income, but quite honestly, at my fees, no one's going to be that poor, to be so. But there is that.
Yeah. All right. Looks like that's it.
Okay. Did I touch on it all?
Yep. Nope, you did. You got it all. That looks like it's it there. Now we'll start going to the questions that we've been getting coming in. Jared says, I had a child in March of 23 who was born in Germany while he was stationed overseas. He filed all the paperwork. Time to get Social Security card. IRS was saying it was too late to get child credit for that year. Is there a way to dispute this for his circumstances working overseas and the timeline for the paperwork for that? Do you have any idea how that works?
Okay, I just froze for a good while, so What did I miss?
Okay, so Jared, who was stationed overseas in Germany, had a son in March of 23, filed the CRBA paperwork, get the Social Security card, all that. By the time that he got it, the IRS said that it was too late for him to get any child credit for that year. Is there any way to dispute that?
You can appeal for that. Now, living overseas and getting through the Social Security or thing, I mean, everything runs at the speed of molasses. But you can fight it. You can go to a taxpayer advocate. That would probably be your best shot. It's free to get a taxpayer advocate. Go to the IRS website and type in Form 911, which is really funny. They call it that. But you can send that to the advocacy center that's whatever your mail center is for the IRS, and they will assign a taxpayer advocate that will listen to your case, walk you through what your options are. And if it's something the IRS messed up on, they will go and go against the IRS and get it all corrected.
Cool. Jared, hope that worked for you. Let's see here. Mark says, on a Roth conversion, you refresh and revisit analysis each year. Do not set and forget once. Correct. Thank you. Thank you for saying that. That is absolutely correct. And that's what I guess my assumption is that if you're doing Roth conversions, you're probably getting some professional help. And if that professional knows what they're doing, they're probably doing it every year. So, but if you are doing it on your own, yes, you need to rerun calculations every year. All right, Robin, I have a question about Form 4684 for deduct federally declared disaster loss in the preceding tax year, Hurricane May of 2024, with roof damage. Filed a claim with the insurance company, went through the process. Can I claim some of the roof replacement costs on my taxes for 24 with Form 4684 and the supporting documentation from the insurance company?
Yes, if it is a federally declared disaster area. 24, we had hurricane after hurricane for lots of folks. And so if you were in a federally declared disaster area, you can claim a loss for that, for your personal residence. Now, your loss is going to be limited to, there's a few different calculations here, so it gets a little complicated. But basically, the difference of the value of your home from right before the disaster hit to immediately right after the disaster hit. So to make it easy, most people will just say what the value of their home was and then subtract what the cost was to fix it. Now you have to further decrease your loss by what insurance reimbursed you for. So if the cost of your roof was $30,000 and insurance gave you $10,000, you have $20,000 of a qualified loss if you are in that federally declared disaster area. Now, on top of that, the IRS takes away $100 because why not? Don't ask me why. But that's it in a nutshell. So yes, you can if you meet it. You will have to look up what the FEMA code is for your disaster area.
Okay. Jared, your next question you and I can get to offline. We'll talk about that. Susan, after the age you are required to take RMD, can you still make IRA contributions?
Oh my gosh, I feel like it's no. I think it's no. No one ever asked me that one.
I was going to say, I don't have anybody that does. I can find out for you real quick because I have a nice little cheat sheet.
There you go. I'm like, I know it's based off earned income, and most people aren't working at that point. But Susan, I know you, so. But I feel like once you hit RMD, you're not allowed to contribute.
You are still allowed to make it.
Oh,
there's no age limit on contributions to traditional or Roth IRAs.
You just have to have the earned income.
Correct.
Okay.
Yep. August, charitable deductions. What amount may cause a red flag of charitable deductions?
It's going, like I said, it's going to be above that average. So if the average is contributing $30,000 and you contribute $50,000, you're going to be at a higher risk. Even then, out of the 15 years I've been doing this, I've only seen 2 Schedule A audits. So it's not a high one that I really see. Like I said, most people that do get the deduction for charity, and sometimes it is just random. They usually have all proof of payment and the receipts, and they can go back to the charity and say, hey, can you give me a summary from your letterhead of how much I contributed? And it goes pretty quickly. So I wouldn't worry too much about it, but do keep records if you are contributing large amounts. Now, if you're doing qualified charitable distribution, like we're talking about from your IRA, you cannot also pick it up on your Schedule A as an itemized deduction. So just kind of keep that in mind, as it either goes out of your IRA and stays off Schedule A, or it goes on your Schedule A.
Gotcha. And Susan, going back to your RMD question, still making IRA contributions, I will have you keep in mind that they don't counteract each other. So you can't just make an IRA contribution in the same size that your RMD is for the year and call it a wash. You still have to pull the money out of your IRA for the RMD and pay taxes on it. They don't just cancel each other out. So there is no nice little loop that you can do and just not pay taxes on the RMDs.
And to kind of factor in on the IRA contribution, you do have up until April 15th or filing your return, whichever happens later, to contribute to an IRA for 2024. So same with HSA. So if you want to max out your HSA, you do have until you file your return or April 15th.
Perfect. Okay. Well, that's all the questions it looks like we have. We only went about 5 minutes over, so we did pretty good. I want to thank everybody again for coming. If you have any more questions, I'll stick around for a couple more minutes. Usually Rachel will too, but I don't want to speak for her. But if you guys have any more questions, please put them in there for the next couple of minutes. Otherwise, thank you everybody for coming. If you had some more questions and wanted to get some more answers to what's going on, feel free to reach out to either one of us. Again, my name is Jaimin Garabedian at Assurance Wealth Management. This is Rachel Knapp at Ramdas Accounting. You can reach either one of us. We'd be happy to answer any questions that you've got. And please, please, please go out and get some help. When it comes to taxes and your finances, find somebody that can help you, that knows what they're doing and that is working with all of your interested parties, because they do intertwine so much. And that's why I think Rachel and I do these so often, is that there's a lot of overlap in what we both do for our clients. So Thank you guys again. Rachel, thank you again for coming on. I'm sure we'll do this again here in another few months.
Give me past April, okay?
Oh, I know. I know that I can't even call you between now and April 15th. So
Yes.
I'll take you out for that lunch, in May.
Yes, it better be with margaritas this time.
Always. All right. Well, thank you everybody for coming. And that is it for us today. And here's to having a great year in 2025. Thanks.